Very good morning to all. In today's session, we are all going to learn about the currency futures, options, and swaps. So let's begin with the definition of currency. Currency refers to an exact system of money which is being circulated within a country. It consists of coins, banknotes, digital money, which always serves a mean of exchange for the particular goods and services. Each and every country has its distinct currency, which is being represented by its own specific symbols and abbreviations. Let's take an example to understand the exact meaning of the currency. The currency of India is the Indian rupees, that is in INR, while the currency of the United States is the United States dollar, that is USD. Let's begin with the examples and the symbols of currency. Different currencies uses a different you can say a specific or a unique symbols and abbreviations, and some of the widely recognized currencies around the world wide are include, that is the United States dollar, that is USD, it's United States, euro in the European Union, British pound, that is in GBP in United Kingdom, Japanese yen is in Japan, Indian rupees, that is INR in India. Australian dollar, that is AUD in Australia, Canadian dollar, that is CAD in Canada. Basically, these currencies holds a different values based on their country economic development and conditions, and they are mainly used for the local and the international trade. Let's talk about the currency conversion and how does it works. Currency conversion is very much essential for the global trade, travel purposes, online shopping around the global scale. When you visit any foreign country or make an international purchase, definitely the cost of goods in that country could be in dollar, could be in you can say European or pounds, so it's automatically displayed on a local economy. So in such cases, currency conversion is very much essential, and it's totally determined that how much you will need to pay in your own country or in your own currency. Let's take an example to understand the concept of currency conversion. So if you're purchasing any form of product on an online store, let's say in China, and it costs around 60 yuan, and you need to exchange the rate between the Chinese yuan and your currency, maybe in India, maybe in Japanese, maybe in dollar. So accordingly, it mainly aims to determine the total cost of its product. So currency conversion are the basically tools which always assist an individual that how to find out the exact values initially, so that you can purchase any product through the online store in any currencies through the currency conversion, which is a tool so that you can get that product into that in your own currency or country. Let's take another section, that is exchange currency rate. What determines it? The exchange rate of a currency always represents that how much the one unit of currency is worthwhile to another currency. This rate always keeps on fluctuating due to the various factors. It could be a supply and demand or a market forces. It could be an inflation rate. It could be an interest rate. It could be any other external factors as well. So let's consider the first major point, that is the market forces, or in other words, we can talk about the supply and demand. Higher the demand, the currency would always you can say build up its value and keeps get a stronger image, while the excess supply always weakens in. Let's talk about the inflation rate. Countries with lower inflation rates usually have a stronger currencies. Next is interest rates. Higher the interest rates, it attract the investors to do more and more investments into the foreign currencies, and it automatically increases the demand for that currency as well. Next one is political stability. A stable government and economy, it always enhances and ensures the currency's value. And of course, it is a major step to consider the political scenario while the government will take a step to forward about deciding or you can see implementing any new currency's values. Next one is trade balance. A country with a trade surplus, it could be an export or which could be a greater than imports, is generally have a stronger currencies. So the more and more trade surplus would be available in our economy, and definitely it will reflect a stronger currency of our country. Next one is understanding the exchange rates through examples. So let's take an example to understand the concept of the exchange rates. Exchange rates is it defines the exact value of one currency compared to the another currency. Let's take an example, small example to give an overview of this concept. If the exchange rate of $1 to Canadian dollar, that is CAD, is rupees 1.0950, it means that the $1 is equal to the 1.0950 Canadian dollars. So let's take a real example to understand this concept. Alice is shopping on a cruise and find out a pair of shoes which cost around European that is euro 70. It also sees the same shoes online, that is in pound 55. Now there is a process that how the exchange rate process would goes on according to the time frame. So 1 GBP is equals to the 1.25 euro. So to compare the prices of the product in the US dollar and in the euro, so definitely we convert the pound 55 to euro, that is 55 into 1.25, as the 1 pound is equal to the 1.25 euro. So definitely when we compare the exchange rate or we convert the exchange rate into the euro, then definitely we could multiply the 55 you can say pound into 1.25, which is equal to this particular amount, and which is equal to you can say euro 68.75. So since euro 68.75 is which is less than, so the allies will take a better option to buy a shoes online with to get a best price, which is already they get in the example, that is euro 68.75, rather than spending the you can say euro 70 through purchasing an online product on an online store. Let's talk about the facts about the currency. The Indian rupees symbol was officially adopted on July 15, 2010, and the US dollar is the most widely used currency in the global trade and reserve. More than 20 countries use the same dollar for their currencies, and the euro is used by 19 out of the 27 European Union countries. The Indian rupee you can see symbol was inspired by the Devagari script and the you can say Roman alphabet. Currencies always plays a significant role in the global trade, and in order to understand the value, the exchange rates and the conversion methods, which always helps the individuals, the organizations, the businessmen who always take up an informed and impactful financial decisions within the organizations. So whether you are traveling abroad, so definitely you must gain a knowledge about the exchange rates while making an international decisions and investing, and and also investing in foreign assets. Knowing how the currencies work is essential for an individuals or the businesses, and the constant fluctuation in exchange rate is always goes on in the currency market, and which is the one of the most dynamic and exciting aspects of the financial world. Let's come to the most important section, that is the currency markets. So what is exactly the currency market is? The currency market, in other words, we can call it up a foreign exchange market, or in other words we can also talk about the forex, or in symbol we can talk about here, that is FX. So it is an important part of the global financial system, because as it is after all in a global settings, exchange of currencies or at a current or a predetermined prices is always being recognized in the larger financial markets in the world, because after all it deals with the global or the international trades where the businesses or the organization in different countries are come together to exchange the goods and services at the international currencies. So one can get a fair chance of a scale with the trading volumes which are always you can say trillions of a US dollar, because as I told, the major fact that most of the countries are actually using the name dollar for their own currency. So in the international market, the currencies which are always deals with more than the countries in dollars only. So the forex market is always facilitate the international trade and the investment, so that the currency conversion process would goes on. It is also useful for the business and investors to understand while operating their businesses across the borders, and of course they must have an ability to exchange the currencies, which is very much essential for the international transactions in different countries. So let's take an example to understand the currency market. If you are in India, a direct code might tell you that how many Indian rupees you need to purchase any sort of product, or in a dollar we can talk about a 1 US dollar. So it is a direct quote for the US dollar to Indian rupees, which is rupees 85. So we convert the US dollar into the Indian rupees, and we just get to know the exact cost of a dollar in rupees. So if we flip this question or flip this example, let's say if you are in the US and wanted to purchase any sort of product, you can say in rupees, so the indirect code might tell you that 1 Indian rupees, which is equal to 0.012 US dollar, and in the US United States, when any of the value of the currency in points, that is 0.012, it means 1.2 cents in dollars. So when we convert the rupees into the dollar, it could be cents, it could be in dollars. So in order to understand, it is for the understanding purposes only. So this means for every rupee an individual could spend a 1.2 cents in dollars. So when we convert, you can easily get the total cost of that currency, so that you can buy a particular product in own country or in another country. So it is very important to understand the market where the exchange of currencies or the conversion of currencies would take place. Next, we can come up to the next section, that is the types of market. So when we talk about, there are two main types, that is interbank or the merchant. So in foreign exchanges, the interbank market involves the banks who always trade the currencies with each other. That means bank to bank trading of currencies. But when we talk about the another market which called a merchant market, it involves the banks trading with their customers. It could be importers, it could be the exporters, it could be a supplier, etc. So the interbank rates are the base rates for any currencies when the banks are willing to exchange their currencies. So interbank rates are the base rates for all of the banks who are dealing trade, who are actually involved in trading between within the banks or between the banks. So these are the rates which is being used to determine the rates which is offered to the customers in the merchant bank. So these the rates which is decided by a bank to trade with the another bank. So these rates are the base to decide the rates which is offered to the customers. So banks is always add a margin to the interbank rate, so while deciding any rates to their customers or willing to offer to their customers to cover up the cost and the risk as well. First one is interbank market. So the participants are always banks who are trading with each other. The major purpose is to facilitate the exchange of the large sums of money between the banks, because after all, banks is always trade in a large amount of money, a large sum of money with the another bank, and that transaction will actually called a market, which called an interbank market, and the rates is always been decided in the pre-decided between the banks in both foreign and selling the currencies. Let's take an example to understand the interbank market. A large multinational corporation needs to convert the US dollars to euro to pay a supplier. So after all, if any of the company wants to convert any dollar to Canadian to make a payment to the supplier, then definitely they will go to the bank, because bank would pay a large sum of money by converting their currencies to the supplier. So automatically the bank will always consider this transaction, and they also in this way the bank help to the organization, and organization need to buy the euros from the another bank in the interbank market. So if the organization go to that bank and just want to convert the US dollar to the euro into the euros, then that bank will go to the another bank to buy the euros, so that they can assist to the organization, and accordingly they will make the payment to the supplier. So this is a whole transaction of the interbank market. Next is merchant market. So the next second market is a merchant market where the banks deals with its country with its customers, its individuals or business or any other, you can say, participants of the organizations. Next is what would be the purpose. It also enables the individuals and the businessmen to buy and sell any of the foreign currencies for its own needs. It could be for the foreign trip, it could be any international trade through the shipping, through the airways, through the waterways, etc. The rates, which is always based on the base rates which was being pre-decided in the interbank, but as it is a base rate, and accordingly the banks offer the rates to its customers, to its clients, to any individuals or the organization, plus a margin rate which covers the, you can say, risk and interest. Example could be a traveler who wants to buy a Japanese yen for their foreign trip, or any importer will paying a foreign supplier in their currency. So if I am in India and I want to make a payment to the Japanese company, so definitely I would I would make a payment into the Japanese currencies in Japan. So this is how we you can say exist into a market where any payments it always being done by a individual to the another company which is situated in another country. It could be in any currencies, and that actually called the merchant bank. Let's talk about the next important section, that is the types of exchange rate system. As you are well aware about the main two types of exchange rate system, that is a fixed and floating exchange rate, and in other words it could also call the packed exchange rate or the floating exchange rate system or a flexible exchange rate system. Let's have an overview of these two types of exchange rate system. So the fixed exchange rate system is the one where the currencies is fixed by the government and the government have a full control to decide the value of the currency. So under this system, a country fixes the value of the currency in terms of some external standard. It could be the precious metal, it could be in gold or silver or any currency of any other country or some international agreed unit of account as well. So the main purpose of this exchange rate system is to adopt or in order to ensure the stability in capital investments and international trade. To maintain the stability, as the major objective is to ensure the stability in terms of international trade. So to maintain that stability, the government always buys foreign currencies whenever they need and whenever the exchange rates gets weaker, and so that they can easily sell that foreign currencies when the government has bought such currencies, so that they can build up a strong economy. So in order to do so, the government is always maintain the large reserves of foreign currencies. In this particular concept, there is a one more concept which comes under this term, that is pegging. So pegging refers the value of a domestic currency which is tied to the value of the another currencies in terms of gold. That is called pegging. So pegging is all about the relation of one value of currency of one currency to the another value of the another currency. In terms of gold we can talk about, in terms of silver we can talk about, or in terms of any other standards we can talk about, and that is actually called its pegging. Next is flexible exchange rate, or in other words we could say a floating exchange rate. It is a free, you can say it refers the rate of exchange which is determined by the market forces, that means the forces of demand and supply. The government has no role on this exchange rate system, and the value of the currency is always allowed to fluctuate fairly according to the demand and supply of foreign exchange. So in this system there is no control of government. They are free to fluctuate, but according to the demand and supply in a foreign exchange market. Let's come to the two more important terms in this particular concept, that is the devaluation and the revaluation of the value of currency. So devaluation, it refers to a reduction in the value of the domestic currency by the government. We are not talking about whatever the reduction in the value, it's by organization or through the political forces. Here the devaluation refers to the reduction in the value of the domestic currencies by the government. Revaluation refers to an increase in the value of the domestic currency by the government. So D means reduction, Re means it's an increment or an increase in the value of the domestic currency. So revaluation refers to a situation when the value of currency with respect to any foreign currency increases in a fixed exchange rate. So when the revaluation process which goes on when the foreign currencies would increase at a fixed exchange rate, then there is a need to revaluate the domestic currencies of a country. Next, the major note in it is altering the face value of the currency without changing in foreign exchange rate. It's called a redenomination. So if you can see, you can just alter the face value of the currency without changing any exchange rate or any foreign exchange rate. That phrases is called a redenomination. Now we can come to the next important concept, that is a foreign exchange risk. What is foreign exchange risk and what it's called for? So foreign exchange risk, in other words, we can call an exchange rate risk. It is a risk which totally hamper the financial, you can say, position of the organization just due to fluctuations in the exchange rates. In generally, foreign exchange risk is a risk that a business financial performances or the financial position will be impacted due to the changes in the exchange rates between the you can see the currencies. So that is exactly called the foreign exchange risk, when any of the organizational performances would be impacted due to the changes in the exchange rates between the currencies. So foreign exchange risk can be caused by the appreciation or the depreciation of the base currency. It could be US dollar to you can say euro dollar. So US dollar is a base currency and the euro is a quote currency. So it is due to the such risk exists due to the appreciation and a depreciation of a base currency of the foreign currencies and a combination of both. So it is a major risk where every organization has to consider to take an appropriate steps or remediable measures so that the importers, exporters or the businesses can also trade in an international market. For example, let's take an example to understand the exchange rate risk. A currency which is based in Canada has a business in China. It receives the financial transactions in Chinese yuan. So whatever the transaction has been done in China, it is in Chinese yuan. So it should report in the financial statements. It should be reported in the financial statement whatever the financial transaction has been done in Chinese yuan, but in the financial statement the such transaction has been shown in the Canadian dollars. So when whatever the transaction has been done, if you show in that country where the business is situated and built up in that country, let's say in this example China, so the transaction would be shown in the Chinese yuan, but it has been shown in the Canadian dollars. This type of transaction is called a foreign exchange risk. So the financial transaction which has been received in the Chinese yuan, that to be shown into the financial statement or that to be reported in the company's financial statement. So any of the changes in the exchange rate between the Chinese yuan, and that is foreign currency, and the Canadian dollar, that is the domestic currency, would be as risk. So if you are changing the currencies and you are showing any changes in the currencies in the reports, that consists a risk, and that risk would be called exchange rate risk, or in other words we can call a foreign exchange risk. Now we can come up to the next important section, that is the types of exchange rate markets. There are two main types. That first one is the spot market and the second one is the forward market. Spot market, it refers to a market where the purchase and the sales of foreign currencies are to be settled within a days. It could be 2, it could be 3 of the deal. So it is a rate in which the foreign currencies is bought or sold, is actually called a spot exchange rate. Next one is forward market. It also refers to that market which deals with the sales and purchase of the foreign currencies in some future or a predetermined rate on a, let's say, in other words, we can talk about the future date. That's called a forward exchange rate. So if any of the you can see or international organization it's dealing with the sale and purchase of the foreign currency at a future date or a predetermined rate of exchange, that exactly called a forward market, because that any transaction will be done at a future date. So if any terms reflects a future date or a predetermined date, that market is actually called the forward market, or in other words we can call a forward exchange rate, because after all we are exchanging the currencies at a future date at a predetermined rate of exchange. That exactly called the forward market, where the sellers and buyers are enter into an agreement to buy and sell of foreign currencies after 90 days of the deal. That actually called a forward transaction. Now we can come to the next important concept, that is called a currency derivatives. Currency derivatives consist of future and the options contract. The future, we always talk about any buying and sale of foreign currencies at a future date or a predetermined, which is very similar to the forward exchange transaction. And the options were always, companies would have an option to buy and sell any of the currency at a fixed rate or a determined rate at the present scenario. That could be called an options, a currency options. So these two basically the concept are actually called the derivatives, which refers to an agreement between the two parties which are regularly traded on stock markets, who are dealing with the you can say future stocks or the stocks or the bonds, etc. So it whatever the transactions or traded would takes place, it could be at a predetermined rate of exchange rate. So whatever the rate would be decided, it would be the pre you can say rate basis, and that rate would be considered to trade shares you can say in the future or at the present, and that is actually called the currency derivatives. Here in this particular concept, the importers and exporters plays a very significant roles, because after all these two are the main participants who utilize these contracts as a protection tool. Hedge means it is a protection tools against the fluctuations in the exchange rates of currencies. So automatically it is a tool which is being used by the importers or exporters in these contracts against the fluctuations of the values in their home currencies or in the home market. Let's take an example to understand this concept, that is currency derivatives. X, an Indian company who plans to import goods worth $1 lakh from the United States. Now the question arises as we have to exchange the currencies. We have to figure out the rate of when we convert the US dollar to Indian rupees. So the currency exchange rate of 1 US dollar is equal to Indian rupees 85 rupees. So how to calculate the total cost of the imported goods? That is 85 into 1 lakh US dollar, because the cost of the imported goods is US dollar 1 lakh. So we just convert the exchange rate and come out with the Indian rupees, because as X is an Indian company, so we have to convert the US dollar to the Indian rupees. That is, the Indian rupees is 85, and whatever that amount that we have purchased in the US dollar, that is 1 lakh rupees. So 1 lakh dollar rather than rupees into 85 rupees, which equals to the 85 lakhs. So here we have figured out the total cost of the imported goods will be 85 lakhs when we multiplied the 1 lakh, that is the cost of the imported goods in US dollar, and the conversion rate of Indian rupees, that is 85 rupees, and we have figured out that you can see total cost of the imported good is 85 lakhs. Now what the currency derivative role plays in this example? Here we are considering the future forward contract. So let's say X enters. The X is an Indian company who entered into a forward contract. When we talk about the forward contract, we always speak about the future date. It could be at present, it could be after 10 months, after 14 months, after 4 months. Then here this process would goes on a forward transaction. So X enters into a forward contract with a bank to hedge. Hedge means a protection tool against the exchange rate risk. So it with the bank X which enters into a contract with the bank to hedge against the risk and agree to buy the US dollar 1 lakh at an exchange rate of US dollar 1, which is equal to the Indian dollar 85, and the contract highlights that the exchange will happen after 4 months. So as if any of the transaction not fixed at the present but fixed at the future date, it becomes a forward transaction. So X will receive the goods. So after the 4 months, as per the forward contract, the X will receive the goods after 4 months. So after a month, let's say the US dollars appreciate, United States has appreciate the United States dollar 1, which is equal to Indian rupees 97. Then X has to purchase in anyhow that 1 lakh imported goods, and which to be multiplied into 97 rupees, which equals to the 97 lakhs. As it comes to a contract, X is entered into a contract, and after the 4 months they will receive the imported goods, and after a month the US dollar has appreciated its value of currency. So ultimately the Indian rupees, the value of the domestic currency, that is an Indian rupees, is also appreciates. Then as a result, the value of the payment that the X company has to pay, it's 97 lakhs rather than 85 lakhs if the US dollar appreciate its currency. However, X holds a forward contract. As I told, the X is entered into a forward contract. That means the X's are into or hold a forward contract, and it will purchase the goods of the US dollar 1, which is equal to the Indian rupees 85. So hence, if the X, as the X is entered into a forward contract, so whatever the rate has been fixed of the exchange rate, that is $1 which is equal to the 85, then X is ready to pay for its goods of rupees 85 lakhs. So if the currency appreciate, it becomes 97. As per the contract deal, it becomes 85. So automatically in the or with its currency derivatives, X can save 12 lakh rupees as it has locked in a favorable rate using the forward contract. And that is the benefit of the forward contract. When any of the company entered into such contract, the deal is locked. Whatever the rate would be fixed or exchange rate would be fixed, it's locked. So suppose in the future the currency would appreciate, then automatically the company has to pay the higher amount than the deal rate. So automatically, if the company has entered into such contract, then definitely the Indian company could save, that is X saved at 12 lakh rupees in the favorable rate which has been locked into a forward contract. So this is how the currency derivative works in a real scenario. Now we can come up to the next important concept, that is the types of currency derivatives in the Indian market. The first one is the currency future. So the currency futures are those contracts which deals with the purchase and the sale of a underlying currency or any currency at a present date or a certain date. We could talk about the stock future, because here we are talking about the contracts which is based on the future date, and the buyer and seller have to exchange rate at present. So whatever the rate which is being fixed, which is based on the present scenario, and that would be logged into a future you can say date. So you have to settle down the contract if you keep open until the specified date which is mentioned in the contract. In contrast to the stock future, you can see currency futures always required to pay the differences of any of the currencies in Indian rupees rather than allow to take a delivery of the underlying currencies. Next one is currency options. Currency options are those which gives an individual the right but not the obligation to buy or sell a particular amount of currency for another currency. That is called the currency options. So these are the currency options are those which gives you the right but not an obligation that you are ready to buy or sell a particular amount of currency for the another currency. So this type of currency derivative can be traded at a predetermined price at a specific time frame. So it could not be called at the future date. No, it not deals with any future date. It is determined as a predetermined as any of the specific time frame which has been decided by the party. So the currency option are categorized into two types, the call option and the put option. Call option, when the underlying currency expires, then the buyer holds the option which is not required to purchase. They can hold an option whether to buy or sell, but they don't have an obligation to do that. So that is called the call option. Put option, when the underlying currency expire, when the date of the currency you can say expire, then the buyer has an option but not the obligation to sell it. So automatically when we talk about the put option, the buyer has an option but they have no obligation to sell that particular currency for the another currency. But when we talk about the call option, so if any of the underlying as currency or any currencies expires, the buyer has an option, but it's not required to purchase it. They can sell also, but it's not necessary to purchase and then sell. So this is called the call option. Next type is the currency swaps. So currency swaps are also the currency derivatives that can assist to convert you can say lender interest rate from the currency to another currency. So such swaps refers to a conversion of the you can say conversion of the lender interest rate from one currency to another currency. That is exactly called the currency swaps. And the institutional investors can also trade this type of derivative over the counter. It could be over the counter at the spot time. They can easily trade such derivative, which is called a swaps. So both parties can change their interest rates from fixed to floating interest or exchange rates, and in this way the transaction could be done by the parties. Next one is the currencies forward. Similar to the future contract, the currency forward are also the customized currency derivatives contracts between the two parties. And the forwards, that means the currencies can also traded it over the counter and give you a flexibility to you can say in contract size that or the expiry date to decide. So this is how the currency forward contracts works between the two parties, and they have an option or gives them a flexibility to decide the contract size and the expiry date as well. And the businesses use these currency forward as a tool which is against the fluctuations in the exchange rates or in the international transactions as well. So hedge is a protection tool which always protect the organizations or in you can say the trade against the fluctuations in the exchange rates of currencies. Now we can come up to the next section, that is the advantages of trading currency derivative. The first one is hedging. As I already told, it termed as a protection tool. It protects your investment from the exchange rate risk or the fluctuations of the you can say domestic you can say currencies or the foreign currencies. And importers, exporters or the institutions also use this hedging tool to increase profits and reduce losses. Next one is trading. Anyone or any individual could also trade currencies derivative contracts so that they can easily capitalize the currencies on a short term gains in the forex or the foreign market. And any individual can utilize various strategies to maximize their profit. It could be open through the trading account, let's say Demat account. We can talk about the PL Capital Group company. There are various companies which is one of the called a PL Group Capital Group company. They have also give a facility, a customized investment strategies based on the individual needs, based on their financial goals, so that the risk can easily customized within that particular time frame. And that is exactly the one of the advantage of currency derivative is trading. Last one is arbitrages. Sometimes traders make a profit on differences of prices of certain currencies between the markets. So country arbitrage allows the buyers to purchase a currency pair. It could be US dollar to Indian, or the Indian to US dollar. So it's called a currency pair. So it is currency arbitrage refers to a process which gives a flexibility to a buyer to buy a currency pair immediately and sell it at a higher rate to another or in another market. That's called arbitrages. So which always gives a flexibility to the buyer just to buy a currency pair, you can say sell it at a higher rate in the another market. It becomes the arbitrage. So this is also the one of the advantage of the currency derivatives, where the just buy it in a pair, just sell it at a higher rate into another market, it becomes arbitrage. Now the question arises is, what is currency pair? Currency pair represents the exchange rate between two currencies, showing that how much the second, that is quote currency, is needed to buy a 1 unit of the first, which called a base currency. Let's take an example in the euro and USD United States dollar, or the you can say euro pair. The euro is a base you can say currency, and the USD is a quote currency. So the exchange rate always indicate that how many US dollars are needed to buy 1 euro, and that's called a currency pair. Let's talk about the next section, that is currency derivatives traded in the stock exchanges. It could be National Stock Exchange, Bombay Stock Exchange, and the Metropolitan Stock Exchanges. So these three types of stock exchanges where the currency derivatives traded. Common currency pairs are in our in around the world would be the euro US dollar, euro against the US dollar, USD is JPY, that is US dollar against the Japanese yen, GBP USD, that is British pound against the US dollar, AUD USD, that is Australian dollar against the US dollar, and the USD and Canadian dollar, US dollar against the Canadian dollar. Next we talk about the derivative markets in India. So derivatives are the financial contracts which where the value is it's always derived from the underlying assets. It could be shares, it could be bonds, it could be debentures as well. So the common types of derivatives including futures, options, and swaps. So derivatives are used for the hedging and the speculation purposes. So in India, the derivative market is almost regulated by the Securities and Exchange Board of India. In India, there are two main types of derivative markets, that is called the exchange traded market and over the counter market. The exchange traded market is where the standardized contracts are traded on an exchange. But over the counter market, it's decentralized. It's not a standardized where the contracts are negotiated directly between the parties. So here you can see the exchange traded market where no negotiation could exist, because whatever the exchange rate you can say exists in the market, that in that rate the transaction would possible. But over the counter, negotiation could take place between the two parties. But over the you can say exchange traded you can say market, the whatever the fixed has whatever the rate has been fixed in the contract between the parties, on that rate the exchange of currencies would took place. But over the counter, negotiation would also exist. Whatever the conditions of a negotiation has been written in the contract between the two parties in case of the over the counter market. Main participants in the Indian derivative markets, the first one is hedgers. Hedgers are also you can say one of the tool to minimize the risk of the adverse price movements or the fluctuations in the underlying asset. Let's talk about the shares or the shares futures or the stock futures as well. So let's take an example. A farmer may use the future contracts to lock in a selling price for his crops or advances of harvest. So if any of the individuals, say a farmer, would like to protect the price of its crops in advance of harvest, so definitely he come into a forward contract, and the hedgers is always helps and work for the protection for such you can say fluctuations in the you can say exchange of currencies. Next one is speculators. Speculators seeks to profit from an anticipated price which changes in the underlying asset. So speculators always focus on the profits, whatever the profits which has been come up from the anticipated prices changes in the particular asset, say a stock or shares. They take an increased risk. They always believe to take a higher risk with the aim to gain a higher return. As in other words, in the finance we always talk about higher the risk means higher the return and higher the or profits. So speculators always believe in that particular aim, that if they take the higher risk means the higher return they would get, and they would get if they could gain profits from the anticipated price changes in any of the assets. It could underline asset, let's say shares or stock. Next is attributors. Attributors is always seeks a profit from whatever the difference between the prices of different markets indicating in an underlying asset, say a shares or a stock. Let's take an example. If they buy a currency at one exchange rate and sell at a higher rate in another market, it becomes attributors. As I already explained what is attributors, which one of the advantage of the currency derivatives, and these are the participants which always do the same role in the currency markets. Market makers. Market makers is also provide liquidity by quoting the bids of the currencies, making or asking the prices for the derivative contract, that what would be the price to be quoted, which indicates or highlighted in the contract between the parties. So market makers is always provide a liquidity so that they can quote the bids, and that price will be highlighted or mentioned into a derivative contracts. So they are also facilitate the trades between the buyers and sellers as well. Currency future and forward. So what would be the differences between the currency future and forward? Currency future and currency forward markets is always differs in terms where the trading mechanism is also differs between these two concepts, and the currency future are the exchange traded currency forwards, you can say the over the counter contracts we can talk about. Clearing of currencies futures mitigates it counterparts the risk, but some counter you can say parties is always build up or remain the common currencies forward trade. Currency futures are also traded in a small you can say denomination rate than the currency forwards. Forward exchange contracts requires the you can say the uncovered currencies, you can say the position in the underlying asset, while the traders can always speculate these positions through the future contracts. As far as the trading is concerned, currency futures are the, you can say, the cash settled, where the currency forwards it's revolve around the physical delivery of currencies. Key features of currency future: it could be standardized, it could be leverage, it could be a daily settlement purposes, that every buyer and seller can also do the trade on a daily basis. It could be a daily settlement, it could be a physical settlement, a physical delivery of the currency. It could be used as a hedging tool in the to enter into a contract. So it could be speculation, where the traders are the use the currency futures to bet on an exchange rate movements, and accordingly they could gain profits from any prices or any difference of prices exist between the current price or the settlement price at the time of trading. And correlation with the spot foreign exchange market. So currencies futures are generally having a you can say mirror movements underlying any of the currencies exchange rates, and attributors always plays a very important role to protect these investments or higher investments from the fluctuations of the exchange rate of currencies. And the last one is accessibility, and the currency futures are exchange traded, you can say extremely traded, which provides an easy participant access. The price transparency is always there, and the counter parties guarantees are always available, so they can easily access you can say in a exchange rate market than the over the counter forward contracts. That's it for today. Thank you so much for listening this lecture. I will come up to the more and more important and relevant topics in the upcoming session. So till time, thank you and namaste to all.